All right. How's it going, everybody? Welcome to another episode of Trading WTF, and where we discuss where to focus today. We're going to be looking at the working with Andrew Sachs, talking to him about the forex industry. He was an investigative journalist and researcher, and we're going to look back at what trading used to be before we had amazing platforms like TradingView at our fingertips and other, I guess, platforms, as well as what's coming up in the future, and probably just talking about the industry and trading in general. Give you a little bit of a bio about Andrew, and then he can probably add to that. Andrew Sachs McLeod is a veteran of the FX industry with 30 years of experience under his belt. Currently, he is the head of research and analysis at UK-based forex broker ETX Capital. He was formerly the co-founder and CEO of Finance Feeds, a popular finance online journal. And before that, he was managing editor at LeapRate and editor at Forex Magnets. Before entering journalism, he ran his own software engineer consultancy firm for over 18 years, which focused on infrastructure for banks and financial institutions. Thanks for joining us, Andrew. Anything you would like to add to that?
Very nice. You're spot on. Thank you very much for that. Appreciate it. Good to be here.
Excellent. Any disclaimers you got to add or anything like that, or you're good? Other than this isn't trading advice. Okay.
And obviously, we're not here to give advice, that's for sure. But we are here to talk about trading and about the general dynamic of the electronic markets, really.
Excellent. So let's start with what was your first job in the financial market sector?
Oh, my first job was a very long time ago because I'm a very old man. It was in 1991, and I joined I had an apprentice. I was an apprentice. I had an apprentice program for connectivity, telephony, configuring switches and routers for trading servers for a company called British Telecom Financial Communications, which is now part of the Canadian Radiance company. So it's like a rival to Equinix, really. They're like a hosting provider for trade servers and data centers and things like that.
Which was the company in Canada again?
Radiance, like R-A-D-I-A-N-Z, Radiance.
Radiance. Okay, yeah.
So that they were not back then. It was before their Canadian acquisition. It was called British Telecom Financial Technology back then, but now it's BT Radiance. So it's kind of a well-known telecoms and connectivity firm. So I did 2 years there, and then I had to join them as an employee. But of course, just at that time, it was in the early 1990s, there was a high-tech industry kind of downturn in Western countries. So I was let go. So I thought, oh, that's interesting. I spent the last 2 years doing an apprentice program to learn this industry, and now there's a downturn. So what are we going to do? So I started my own. I looked around, found everybody in the same situation. So I started my own consultancy and went back as a contractor. And I had that company for 18 years.
Oh, nice. And when you began your career, how were people trading?
Oh, very differently to today. They were, I can really speak at that time for the institutional interbank world, because the retail trading market was relatively undeveloped back then. There were some big companies. For example, ETX, this company, ETX Capital, did exist back then. This company's been around since 1965. It's one of the oldest retail FX and CFD companies in the world. But there were only a few. There was this one, there was IG Markets, there was CMC Markets, which was a couple of years old. That was founded in 1989. There was a few ones that you see now with their own platforms, like Interactive Brokers in the United States and FXCM a bit later on. But the actual deluge of retail platforms that use Metatrader didn't exist back then. So the majority of what I saw was interbank transactions. And believe it or not, people were using spreadsheets to make trades, and they were actually keeping their order book on a spreadsheet, which a lot of old school traders in banks and in prop shops and exchanges got used to that. So they tend to carry on with that spreadsheet orientated way of keeping records up even after the electronic dealing desk and electronic platforms came to fruition. A lot of people did stick to the old spreadsheet, particularly institutional traders.
trading off the spreadsheets.
Yeah.
And then what? Phoning it in or faxing it in?
Yes, both, exactly. In the mid 90s, a lot of fax, a lot of phone, a lot of voice brokerages were quite big then as well. You had companies like Tulip and so forth, and they actually were doing a lot of. There's another one, isn't there, with 3 letters, which I forget the name of now. Very, very well known, big voice brokerage that's based in the US and the UK. It's quite big. They still around doing a lot of that. Tulip was a big one. There were some back then. There were still some trading floors, some open outcry floors where you actually had to go there yourself, and there was no electronic platform whatsoever. People were just going there, and if they had people working for them, if they were brokerages that had staff working for them, they would all go there together and actually execute the orders on an open outcry pit by actually literally yelling the orders across the trading floor. And then you'd have a big board there with numbers, and they would all be the totals. And actually there are some people in this industry today who were technology experts in those particular exchanges back in the old days of when it was an outcry pit operating those systems which recorded the orders. You have London Metal Exchange here, one of the inventors of the Liquidity bridge, which now connects the Metatrader platform to live markets, was actually the chief technology officer at London Metal Exchange. So that type of analog technology got itself eventually into the retail market that we know today.
And then at what point did the market start to evolve? What were those evolutions? What do they look like?
Well, they were very interesting. It was 2004 was a particularly important period, because that was when a company called Metaquotes, that we all know, it's a company based in Cyprus called Metaquotes Software, launched the Metatrader 4 trading platform. And that was a off-the-shelf platform that you could just lease. You didn't need to do any technology. There was no setting up. You didn't have, brokerages didn't have to be what we are, technology financial technology companies, as well as execution experts. They just had to be sales floors and look after their customers. They could go to Metaquotes and get this off-the-shelf platform. But the problem with that was that it was designed as a kind of marketing tool to allow people to onboard customers. It didn't have the ability to connect to a live market. It was designed to be a closed system so that you'd have a trader here and a broker here, and they would trade against each other, which is not really trading. And that really was how it was designed. It was designed for affiliate marketing. So I'm not a fan of that, never have been. I think that brokers who have their own infrastructure are always going to have a longer term client base and a product offering that they can keep evolving to their clients' needs. But Metaquotes nonetheless got very popular. So that was the first bit. And what happened was, during that period, from 2004 until about 2010, quite a long period of time, loads and loads, thousands of newly registered brokerages came to fruition, most of which were tiny companies with 2 or 3 people, and they were affiliate marketers. They used to buy advertising on the internet, and then get people to call anyone who's clicked on those adverts and have them deposit funds. But it was all focused on depositing funds. It wasn't focused on actually making any live market or profits from trading, or any commission-based spread trading that we're supposed to see in electronic markets. So there was a lot of that, and that woke up the regulators. The regulators started looking at this very severely, and at that point, about 12 years ago, 2 or 3 specialist software companies developed bridges so that you could actually make that platform connect to live markets, because by that time so many traders around the world had got used to using Metatrader 4 that it was only a question of trying to, if a broker wanted to get to give any traders good access to markets, but do it in a way that was going to be familiar to traders, they'd have to use Metatrader 4, but make it so that it works with a proper brokerage. So that now that is entirely possible. And I think that is now we see something like 1,400 of these Metatrader platforms with different logos on them around the world. So that's a big evolution. The retail sector has grown. The number of people trading from their living rooms and making an extra income by being at home has grown exponentially. It didn't used to be like it is anywhere near like it is even 10 years ago, I would say.
Yeah, well, thanks to COVID, there's a whole new generation of traders that was born from there.
That's right. That's definitely right. In fact, the last year and a half, there's been a massive increase. I was the other day speaking to a good friend of mine who actually works in another brokerage, and he told me that right now, in the UK alone, there are 185,000 leveraged traders. That's a lot. 4 years ago, it was 40,000.
Wow. Just 4 years ago? So it's,
yeah. And the majority of that increase has happened over the last year and a half since for various reasons. There were people who did keep their job, but they were at home, so they weren't commuting and they were in front of their computer for longer, so they could do their job and then trade as well. Or there were people who, unfortunately, intelligent, educated people with good business and analytical skills who lost their business or lost their job, and they had to think of another way of making up the difference. So they started learning how to put that to trading instead and become more self-sufficient.
Yeah, well, everybody likes to be right, and I guess trading is one good place to try and be right if you're lucky.
Yes, that's right. And I think you have to go into it with the right approach, because it still is very much the case that not everybody wins. You don't always make a living out of it or a revenue out of it, but of course going into it with the right approach and having enough, taking it steady and learning things according to using the right learning resources and keeping in contact with your broker and making sure you don't make rash decisions is the right way. You have to approach it like you would any other form of self-employed business, very analytically, very carefully.
And in terms of the success behind Metatrader 4, what was that success that was out there? Because if you look at Robinhood, they're successful probably because they made it accessible to everybody. You can buy shares for $5. They let you slice and dice it. Whereas before you need to buy like 100 units of a share or something like that. So that, and then TradingView, they're like one of the most viewed websites in the world on a daily basis for traders. What are the factors that made MT4 attractive? Are there similarities between Robinhood and TradingView, or are those different factors completely that make each of them successful?
Yeah, I think they are different factors. I think Robinhood went for this very modern app-based, trying to rival some of the stockbroking firms and banks, but doing it in a very trendy way. And it didn't work out 100% well. They've had their ups and downs. They've had a few issues that have been very high profile. But then you have Metatrader is different. That was really a tool for anybody who wants to start up a brokerage to be able to quickly onboard clients, traders. And they were people, this is a different type of thing altogether than being seen before, because the majority of those who were targeted initially in the beginning part of Metatrader were people who'd never traded before and were in regions where there's very scant regulation. And the model was to get people to deposit small amounts of money. And that is a sort of affiliate marketing model rather than a trading model. It's not possible to trade markets with a small amount of capital like that, and it's not the way to go and try to get people to deposit into a non-entity that no one's ever heard of. Isn't trading. It's really living off the deposit of customers, and that's problematic. I think and then of course what happened then was you have a whole generation of people who'd never traded before, never been in the same business, had been targeted by entities that had come from other industry sectors, not from the electronic trading or the financial technology sector. They'd come from marketing and other online e-commerce businesses, and as a result you have then a whole generation of people who think that Metatrader 4 is the only that's all they're used to. So that gave it a lot of popularity, because other brokerages that wanted to take bona fide brokerages who wanted to get those clients on board and give them a better service would have to offer them a platform they're used to. So it was an easy way of being able to bring traders to other brokerages, be transferable. Also, traders could then choose whichever brokerage they wanted to go to and not have to learn a new platform. So that was really what gave it its initial popularity. And then in China, when that market really exploded, a lot of Chinese companies rather than individuals were trading very large amounts of capital, all through Metatrader 4. And the reason for that is because Metatrader 4 is compatible with trading robots that you can design yourself. So there became a lot of different, what they call expert advisors. I know EAs, expert advisors. They're effectively trading robots that you can design yourself. So a lot of these companies would design those automated robots and then connect 15 or 20 accounts to one MetaTrader and allow it to trade itself. Nobody in China was trading their own accounts. They're all done by that. So that kept brokers who were interested in having customers in a global environment using MetaTrader. However, here in the UK, MetaTrader is very rare because it's a bit of a different trading environment here. It's called either spread betting or contract for difference trading, CFD trading. So that's because the British government treats the tax differently. If you trade as a trading the markets, you'd have to pay tax on profits. But in Britain, where rather strangely gambling and betting is legal, believe it or not, you can actually get a spread betting account or a contract for different account, which comes under that tax classification, even though it isn't gambling, and you don't pay tax on your profits. So therefore, companies in England have their own trading platform, because a contract for difference platform and a spread betting platform is different to a spot trading platform.
Interesting. Well, it was touched on some points that were interesting in terms of coding and programming your own strategies, because I don't know, you're finding a world where people want to think less and want to have everything at their fingertips.
That's right.
Do people program their own strategies still, or and what languages do they use? And if they don't program, what are their other options?
They do program their own, yes, they do. However, a lot of them are done talking of languages, MetaQuote has its own, and don't get me wrong, I am by no means an advocate of MetaQuote. It's just that is the most popular in terms of these trading robots. They have their own called MQL5. That's Metatrader. That's their programming language. So a lot of these robots and strategies are coded in that language so that they can be attached to those off-the-shelf platforms. However, in the more sophisticated realms of trading, which is where you have companies with their own trading platforms and their own infrastructure they've developed themselves, you would then be looking at things like robo-advisors, which are third-party software, or you would be developing your own in-house automation tools. And most of that is done by proprietary trading companies. They're companies that trade their own accounts. They are professional traders who they trade their own account, and they make their money on that. And a lot of that is coded in-house. However, there's a big difference between traders that use bespoke or proprietary platforms like ours, or like IG Group or CMC, companies that have their own software and their own trading infrastructure. Generally, the people who trade that are self-directed traders who are actually manually trading their own account rather than using a robot. So you find that a lot of the traders who trade using companies that have their own platform are very analytical people who are studying everything themselves, making their own trades. Whereas a lot of MetaQuote's popularity is because of the Southeast Asian market, where there's a lot of automation.
Got it. Well, we got a question. We're streaming all over the place today. We got a question from Twitch, and they're saying, how do you think AI will impact the future of platforms like Metatrader or others?
That's a very good question. I think it certainly will. I think it already is doing to some extent. And I think where it will first impact, at the moment, the focus is on not necessarily the actual execution of trades, but it's on the brokerages themselves, which are using AI to determine the buying behavior and the lifestyle behavior of people, private individuals. So when, therefore, they would be able to offer the right kind of products, financial products for them, because now brokerages need to go down the route of becoming a bit more comprehensive than just offering spot forex or some a few ranges of products. You need to become almost like a digital bank to some extent, where you can have a card and an actual account, and then have underlying assets that you can trade on markets. So I think the AI aspect there will be about how to figure out what traders and investors want, and give them an asset class and a risk category that suits them, so they would stay as a longer term trader. I think that is where it will start. In terms of trading platform AI, that's really not that is likely to happen, but I don't think we're going to see that for quite some years yet.
Yeah, I think it's going to take some time. Like on the AI side, you have the programs that you code. I think that's the closest you're going to get to AI for the near term, until you've and then I've seen people that have multiple different programs that they think will act as an AI, because they're like, okay, when this happens, then this is going to come into play, and when this happens, that's going to come into play. But I haven't seen anything learn on the fly and kind of correct itself and develop. You need code to do that.
Yes, and I don't think we're there yet, really. I've seen a few years ago, about 5 or 6 years ago, there was a lot of AI was a buzzword, and a lot of companies were putting out press releases saying they're going down the AI route. But we haven't got there with that yet. It's not there, but it is there with knowing. One of the biggest challenges is it's an online business. You have traders trading from all over the world remotely. They don't go into an office and work with their colleagues like you would in a proprietary trading shop or in a bank or something like that. They are trading remotely from all over the world. So it's an online business, and therefore, to some extent, faceless. So I think where we are going to see AI first is where good quality brokerages and companies will use it to know what their customers do and what their customers want, and try to give them a product range that suits their profile of buying and of risk appetite and of what they want to achieve for that particular moment, without actually having to waste the time trying to understand, and then it becomes irrelevant. I think the AI will be used to know the client more than it will to be operating a trading platform.
Giving each client their own avatar, in a sense.
Yeah, pretty much. That's right. Exactly.
Yeah, well, it's interesting. Well, a lot of people are watching trading stuff on Twitch, and it wasn't like Twitch just supposed to be for gaming. So I think it's evolving quite quickly.
That's interesting. Well, that's a really interesting mix, don't you think?
Watching trading on Twitch online.
Yeah, that's very interesting.
Well, I think it's the evolution of the trading room, all right? Because people want to be with a mentor and be with a trading team, but I think being on Twitch gives a lot more validity to the reality behind the person who you're following or teaching.
Yeah, I think so too. And it's also wide. This is the thing that's important now. We've gone past the stage within the 90s where all the original traders who were doing these downloadable platforms are now 60 years old. The people who are 30 are doing what you've just suggested. They are using these apps, and they're combining things like Twitch with investing, and they are looking at things differently. They're looking at risk or reward in the same way they would in a game on Twitch or something. It's not the same as treating trading as gaming. It's just that people think laterally, and they want to see what can be made relevant in different platforms. Just like subscribing, these are the same type of people who subscribe to everything instead of buy things. It's the same. It's like a distributed world that we live in now. So if you can distribute something across, if you can distribute your house and your clothes across one platform, then you can distribute your bank account and your trading account across a platform that does something that's entertainment focused as well.
Then comes in play blockchain connecting the world to everything.
That's very true. Yes, that's where that's going, I think.
Yeah, I think those are the applications for blockchain, is to be able to connect the dots for those. It's becoming more and more of a data-driven world that we live in. And yeah, just going back to the last point, trading, maybe like 20 years ago, people were looking at a newspaper and they were looking at reading the facts and stuff like that, and the report on whatever they were looking at. Then there's the financials, the corporate history, and and the projections. And how do you get all that information in one little bite? And it's before you were spending half hour, an hour just researching one point, and then you'd spend a week, a month getting to really know that company, that product. Now it's just like hashtag, Twitter comment, and there's the news.
Right, and that is actually a very good point that you make there. And you've been in this industry for a long time, Michael, so you know as well as me that companies have tried over the years to fight. That is a very important niche, and there's a lot of companies who have tried over the years to produce software that does that, so that somehow you can actually get a trading platform with a piece of software which then aggregates all the things that are going on in the world and puts them in a place where you can see it all in one go and try and act on it. Very difficult thing to do, very difficult. And there are lots of attempts at this and a lot of failures at this. It's not been an easy road to go down, and there are only one or two companies in this industry who are actually able to do even half of that and still be quite popular. And some of them have a very aggressive way of trying to get brokers to work with them, because it's one of those competitive areas where traders want all this information. We live in this information age, and everyone wants as much information as possible. But randomizing it and automating it through score boxes and through integrated stuff that matches your trading platform has not been easy for a lot of companies. And we're now back to the point where analytical traders are starting to read research, and it's gone past that stage, because you're quite right. Twitter and YouTube and news and analytics portals and things are the things that people are reading nowadays. They're not looking to these integrated randomizing platforms. They're looking for people, humans on YouTube or on Reddit. Look at Reddit. Look at that. It's gone the other way. Instead of randomizing data to act on, Reddit board people are actually going on Reddit and then influencing the market the other way around now. It's them. It's the people on social media who are just traders, retail traders, crashing brokerage platforms by going onto Reddit boards and moving meme stocks around and doing all of they're really sort of self-appointed market makers. So it's gone the other way around, I would say now.
Yeah, and touching on that, in terms of data, analyzing information and absorbing it, I think probably over the last 5 to 10 years, there's been a focus on creating algorithms that can read through the data, detect keywords, and then as keywords are detected, they make split-second decisions based on those words, like that. Right, for the different reports from the ECB, from Janet Yellen, that's where they were really coming into play. You'd see the markets have a sharp move when the statement came out. Like, how do they have time to react? Well, they're just they're analyzing the words in the statement and making predictions based on that. And now with, as you mentioned, Reddit and whatnot, you can beat the big firms once, but they're just going to create an algorithm that scours all these chat boards and then picks up on different things, and will learn how to track it and move on it.
Yes, they will, and they already have been doing this. The big companies, these big trading companies that have got their own compatibility and so forth. However, some retail brokerages, especially ones that don't connect to live markets, have been relying on low volatility for a very long time. They've actually built their business based on low volatility. And then because they're not connecting to a live market, they're running what we call a B book, and everybody does this. They're running what we call a B book, which is where you get a price from the banks or from a non-bank market maker or from the live market somehow, and then you don't send the trades to it. You just emulate them on your own trading. You execute them in-house, but you kind of follow a price. That's called B booking, and of course, many companies do it. It's a very common risk management tool. As long as you do it according to the correct pricing, that's fine. There's nothing wrong with that. But a lot of companies, even very big, some very big publicly listed companies, have got so used to low volatility and running this internal trade warehousing system that when suddenly a group of Reddit users come along and influence the markets, they can't cope. And there were 30 different brokerages that couldn't cope and locked their customers out with open trades, which was a massive cause of panic across the retail trading sector. Now those 30 companies are in a bit of trouble because they're in a class action lawsuit in the United States for locking their customers out of their accounts whilst there was volatility. And the volatility was caused by people like anybody. It could be anybody who happened to have access to social media and were just putting their opinions about meme stocks on social media.
Yeah, it's I get it, because and a lot of the clients have been trained by all these Bibo companies with the marketing and such, and they're like, I can buy as much as I want for that price. I'm like, well, there's market depth and liquidity. Like, if we're putting the orders through the market, there's only a certain amount available at this level, and then at the next level there's this amount, and each level is a different price. And that's how markets get made, because there's supply and demand. You only want to buy there's got to be a match for buying and selling. There's not just an infinite number of units available at a given price. It's based on supply and demand, and that's how prices get made, effectively: supply, demand, bid, ask. But
yes, right.
On the B book, they're just trained, okay, just as much as I want for this price. That's it.
Yeah, exactly. And then when they got shut out, which a lot did, not here, I hasten to add, but they did in some companies, there was panic, and they were not answering the phones, and they were locked out of their account with an open trade, whilst there was all that volatility. You could be stopped out and lose, or even worse, go into negative client balance, sometimes happens if there's high volatility and you can't close your trades. It was a really egg on the face moment for a lot of companies, and it exposed that model really to be relatively obsolete, because now we are in an age of people who know how to move the markets themselves without actually they are perhaps in control of the markets, and the B book brokers have to follow their lead to some extent rather than the other way around now. Yeah.
Well, just create one crazy algorithm and you can always create some pandemonium or havoc. So, and I guess talking about volatility environments, we're seeing the crypto space take off as a high volatility place. Yeah, you got moves in a day of 5, 10, 30%, even 100% sometimes,
right,
depending what you're looking at. There's definitely, I think, some of that, a large part of that retail audience is moving from FX to crypto because of the volatility.
Yeah.
What are your thoughts on that?
Yeah, they are, and because of the volatility and because of the potential, and it's actually not just people from the FX and CFD sector. It's people who've never done it before, and this is really fascinating. If you think go back 5 years or something, 6 years, when the Swiss National Bank pulled the peg on the euro and franc, and it caused volatility because they did it without any warning, and the Swiss National Bank is a private institute. They're not answerable to anyone. They can just make that decision and away they go. And it caused massive volatility. Some brokerages went bankrupt. Some banks were left exposed to negative balances that they'd lent their counterparty credit money to brokerages. And it was a big disaster, and the regulators stepped in and everyone talked about it for a year. It was one of those things. However, that was a genuine market event, and it was what they call a black swan, an unusual wave of volatility. And everyone started talking about it. Those who'd never traded before said, "Oh, I'm not trading. That's too frightening for me." Or you look at what's happened with all this volatility that happened like that. Then now with the cryptocurrency, which is not backed by anybody, is what we call in the software industry airware, because it's non-tangible and doesn't exist. And you have Elon Musk, who is a nobody. He's nothing to do with the markets. He's nothing to do with trading. He's just an social media influencer is what he really is. He comes along in May and says, "Oh, look, Bitcoin is bad for the environment, so we're going to stop accepting, you can't buy a Tesla car with Bitcoin." Suddenly, $1 trillion goes off the price of all these different cryptocurrencies. But that's not because you can't buy a Tesla with it. That's because Elon Musk is an influencer. And he's saying, "Oh, it's bad for the environment." So everyone knows that he's going to vote it down and other people will follow. So therefore, they back out. Now, that's huge volatility caused by just something someone says on social media, rather like an exaggerated version of these Reddit forums. Very similar principle, celebrity influencers like that. And but the ironic thing that they have $1 trillion like that in a day, and ordinarily people would be going crazy. Can you imagine? Think about when Lehman Brothers collapsed in 2008. The whole world was almost as though something had happened, a war had happened or something. It was a huge international subject of debate, and the regulators went after people, and there was people in trouble for it, and all sorts. And then the Swiss National Bank did what they did, and there was people looking to be in trouble for it, and so forth. Then this thing happens. Somebody who has nothing to do with our industry comes along, says something, and a trillion goes off. What you then find is educated middle-class people from all over the world who are conservative and don't waste their money, started investing in it. Nobody went nuts. Nobody started saying, "Oh, someone needs to go and hang for this. Elon Musk needs to get in trouble. Twitter needs to get in trouble for allowing it. There shouldn't be all this." Nothing like that. What happened was people like your middle-class people with good jobs and who had responsibilities started quietly investing in it, because they knew that if you can take it down that quickly, all it needs is someone equally famous to go on Twitter and say something else, and it will go back up again, which is exactly what happened. And it was funny enough, it was Musk himself who planned it out the whole time. He waited a little while, goes back there after a week or so and says, "Oh, I've talked to some Bitcoin miners now, and it's all fine. And now there's a picture of a green leaf behind me, and it's all fluffy clouds coming out because we've fixed the environmental issue." And then suddenly up it goes again. So everyone made a bit of money out of this social media wave. And that is the market we live in today. That's the decentralized, social-driven, influencer-driven market that's now taking off.
That's why it feels, I don't want to say bubble, like I think there might be some use cases for it, but yeah, you're looking at Tulip Mania when people are basing their decisions on, there we go, they were flying around. When people are basing their decisions based upon, so when people are basing their decisions based on tweets instead of understanding where the value is created from, they're just saying, "Oh, there's a tweet, let's buy it. Someone else is behind it, let's get on it." It's kind of like the buffaloes running off the cliff. They're all just, stampeding off the cliff one after another.
Yes, but you can kind of see how that happens, really, can't you? Because people are easily influenced, which is why the influencer market is so massive now. I was saying the other day, you saw the other day when I was talking to Andrew Marina over in Cyprus, that I've got a neighbor who lives in my same condo as me, who is a professional social media. There's a few of them, actually. I know a few of them are there. But there's one particular one who is well known because she isn't someone who, this is not a very nice thing to say, but she's not someone who is an influencer because of her knowledge. She's just figured out how to get lots and lots and lots of attention on Instagram and then sell the advertising space. So you can, it shows you how you can very easily influence lots of people in the same direction these days. And all this is by having a car which is covered in Swarovski crystals. That's all it is. Just a car, a second-hand car, covered from top to bottom in Swarovski crystals. And she hires a film crew, gets some students to look like they're a crowd, and the film crew has a big boom and a microphone, so it looks like the sort of thing you'd see after a massive superstars music concert or a football game that's something high profile. It looks like that, and then they just photograph it and it goes up on Instagram, and you're talking about hundreds of thousands of followers. Then you go and sell it for advertising space, and she can afford to live. She's half my age and got a better house than me in Chelsea, down in Chelsea on the embankment there. People work all their lives for that and sometimes still don't get it. So that shows you how the crowdsourcing of influenced people is today's opportunity. And I don't think it's a time. I don't think it's a bubble. What it is, it's an of the time trend is what it is, because it's in every sector now. It's not just in trading or in advertising. It's in or software engineering. It's in every single sector now. Is this influencer driven marketplaces? And you can, I know this is a touchy subject, but you can see how the governments have used it to influence people down the road of believing in all these lockdowns and things like that. That was an influencer driven, propaganda driven, media driven campaign. It wasn't in the Western world, it wasn't a legal campaign to say you must do this. It was influencer driven and people followed it. So you can see how now, you can totally see how these distributed marketplaces now are definitely of the moment.
Yeah, you can definitely see when they make their public announcements or the commercials, and like I've been able to travel through different countries, and there's definitely a tone that they're putting out there in the media, and there's not a well, I wish we could look at the numbers in more depth and it be a more of a science-based conversation than a fear-based conversation. But
then again, so that's exactly the thing, isn't it? You can apply that to trading. Science-based stuff is for algorithm developers and analytical people, which there's not so many of. Fear-based, influencer-driven stuff gets everybody, and then you will find that it becomes a trend and people start following it. You even have people using these government words like social distancing and isolating, and they're using it as part of their everyday vocabulary now because they've been influenced by all of these media, very, very clever media campaigns. You can really influence now with this social media interactive internet system that everybody uses. Everything is very easily propagated and influenced now.
Yeah, it certainly is. Well, I guess we're on the crypto space a little bit. Going back to your conversation you had last week with the other Chance, what does a decentralized exchange look like, and how does that compare to the other exchanges people are used to?
Well, they vary a bit in their makeup because there are quite a few different ones now, and it has taken a few years for this to actually come towards any mainstream use, because these decentralized exchanges have been around for a few years, but they were at one point not very reputable. There's been a lot of instances of decentralized exchange owners running away with people's money, like Mt. Gox, the Japanese exchange about 10 years ago. That collapsed. $800 million worth of client money was basically stolen by the owner of the company, and he ran away and was caught by the police in Costa Rica. So it's kind of not. The image of it, how it started, was this kind of maverick behavior. But nowadays things are very different, and you have these blockchain projects which have got what it looks like now is a comprehensive financial technology venue. So you can go, you put your hard currency, your normal dollars and euros and things like that in it, and it will convert that to cryptocurrency. So once you're then on the exchange in cryptocurrency, you can access markets all over the world, and you can also do things like sign contracts, because some of these cryptocurrency units have smart contracts, because they're built on the blockchain. So you can actually, for example, rent an apartment to somebody, they will pay you in cryptocurrency, and then you send them the smart contract can be signed via their cryptocurrency. Things like that. So I see it being more an adaptable, borderless, comprehensive range of financial technology instruments. And also, I don't see it as a currency. It is more an instrument. It's more like a commodity, because there's a finite, you have to mine it. Okay, it's electronic, but you have to mine it. So what can be stored on an exchange is a finite number of these things, rather like gold or other precious metals, where there's demand for them and there's a finite ability to mine them. So it is an exchange. A decentralized exchange is an exchange that isn't operated by a central counterparty that works with banks and things like that, where anybody can participate in it, and you as a cryptocurrency or blockchain developer are actually part of the development of the cryptocurrency and of the blockchain technology, because your ledger system is everything passes through your contract, through your cryptocurrency. So it's all a kind of peer-to-peer platform, really, is what it is.
So is that the difference between the decentralized exchange and the centralized exchange? It's more peer-to-peer versus facing a custodian?
Peer and centralized exchanges are a central counterparty. So you are here, the other trader is here, and the central counterparty is in the middle, where you, for example, CME Group or London Stock Exchange, they're centralized exchange. You have the centralized exchange in the middle, which is regulated by the Exchange Regulatory Commission in each country, and then the trades are executed via centralized exchange. Decentralized means it's peer-to-peer. It's all distributed, and you can actually also participate in creating currencies on those exchanges by it's called staking, and they stake you can actually get paid by those exchanges for actually manufacturing cryptocurrencies and things like that. So you also sort of become a self-employed exchange operator to some extent. That's how I see it.
Got it. Exchange. You're an exchange operator, I guess. And what happens if there's not enough participants in the network? I guess the pricing gets bad or liquidity gets bad.
Yeah, liquidity down, and pricing that happens is called the hash rate, which is the difficulty that it is to mine these coins goes down, which means that there's more demand. Sorry, more supply, and less demand, which means the price goes down. So you end up with just volatile cryptocurrencies, basically.
Okay, I see it. If the network isn't mature enough, then there might be not enough supply, or maybe not enough demand.
I agree. As we've just seen with the Chinese government going around knocking off all these cryptocurrency mining rigs in China. And Chinese people, so funny. China is a communist country and doesn't want anybody doing anything outside its borders. So what do? The Chinese mining rig people go and get a decentralized, participate in Bitcoin mining, which is completely counter to China's communist government's ethos of empowering people on a global basis and having them take part in their own decentralized monetary system, and then use free electricity provided by the state to power enormous mining rigs to mine the Bitcoin. So of course the government starting to put a stop to it, and that these people realized that it was going to happen at some point, so they did it until the government started having a go at them, and then they started dumping their mining rigs. So what people thought was, there's now going to be a massive downturn in mining, because 70% of all mining was done in China. So yes, if the system wasn't mature enough, there wouldn't be enough mining, and therefore the demand would go up and the hash rate would go down. However, nothing really happened, because people just started paying the electricity and mining somewhere else.
Yeah, so if it's still profitable to do it, the price is high enough where it's profitable.
Yeah, there's no other choice. You can do nothing about it. You've got to start paying your electricity and joining mining pools. So it stress tested the whole ecosystem, really, is what it did.
Well, yeah, I definitely think the whole buildup of Bitcoin is certainly very sophisticated, in that there can't be any more minted and there can't be any more done. There's always the limitations with transaction speeds, but
that was a very clever initial topography by Satoshi Nakamoto, when it was invented. And they've all followed the same pattern. All of these, apart from stable coins, which is different, all these cryptocurrencies have followed the same pattern of being finite, and you can't keep just making infinite ones, because that's how inflation happens.
Well, inflation is another question for another day, I'm guessing, because that if you print more money, shouldn't things go up? But that's just the basic economics of it. But if everyone's printing money, then things don't go up as much.
Well, I think in cryptocurrency, it would be viewed differently, because it is viewed very differently to everything else. And people's reactions to it, like we're saying about this thing with Elon Musk's tweet, people's reactions to it are very different to how they react to other things. So it's rather like the school bully. If you think about the school bully, who is an uneducated and coarse and is aggressive, and he's always been like that, then the teachers and the authorities and everyone else in his class will hold him to a lower standard. So they expect that of him. So when he starts being boorish and bullying people and being aggressive, he gets chastised a little bit, but not much. Whereas if the school academic, who is a genius and is always paying attention and is never rude and so forth, says one swear word, he'll be in very big trouble. It's like that. It's being viewed completely differently, because the two ecosystems are being held to different standards. So when Lehman Brothers does a mistake or something, then everyone goes nuts and the guys get arrested and jailed and it gets all liquidated and then restituted and everyone sues them and things like that. When the cryptocurrency market goes down $1 trillion, oh, I want to get in on that now, because it's gone down by $1 trillion, so it's going to go up, because they expect that of it. That's why, people expect that of it, so they take an analytical view. So it's two different worlds, I would say, really.
Yeah, it goes up $1 trillion, goes down $1 trillion. That's just money movement, money going in, money going out. It's like,
the result of that, I think, when you look at traditional inflation, if you look at inflation in normal fiat markets, people are afraid of it, banks are afraid of it, governments try to stop it because it kills national economies. We've seen what's happened in various countries, in Russia 5 or 6 years ago, when I felt so sorry for people. The government decided it had too much debt in dollars, so they revalue the ruble, so it writes off the government debt. Everyone else ends up paying for it because suddenly their money's worth nothing.
Yeah.
Then you end up not being able to buy your groceries and things like that. So that's usually what happens. But with cryptocurrency, it would be the opposite. If you started not having that cap that stops you it's not finite, they could keep doing it. Nobody would be interested in it because it's too finite. It's infinite. Nobody would be interested in it. It would just be seen as a programming exercise. The whole reason why people are fascinated with it is because of this mining challenge and this finite resource thing. They are fascinated with. That's why people are spending a fortune on electricity and big mining rigs to try to get those bitcoins. It's like looking for. You remember that children's TV show in the 1970s, Willy Wonka and the Chocolate Factory? It's like Charlie getting his golden ticket. Some of them went through. They were hiring people to shell all these chocolate bars to try and get the golden tickets out of the chocolate bar. It's that mentality. If there was a golden ticket in every chocolate bar, no one would care. No one would even buy the chocolate bar. It's that mentality, I think.
It's totally that mentality. Everybody wants their golden ticket, get rich quick.
Yes, it's that. Absolutely.
Yeah. Well, with getting rich quick and us being in the trading industry for so long.
Yeah, it's kind of moron in my case.
Yeah. I guess. What kind of final words do we have? Like we got through an hour. I think we can chat for hours and hours on everything that's going on.
We have many times, and we certainly have. So yes.
Well, when I get my butt over to London soon, we'll definitely have a nice dinner. And
absolutely, we will. I very much look forward to that.
excellent. Well, I guess any final words to the audience out there about trading platforms, anything else, where they can find your research?
Yeah, absolutely. Thank you. I appreciate that. Well, I have a research and analysis. I have 2 daily research channels. One is on YouTube under ETX Capital, which is daily videos. You'll find my very opinionated viewpoints, and they're not very orthodox. They're quite fun to watch and only a minute long, just viewpoints on what's happened in the day. And I have a written one, which is the news and analysis section on ETX Capital's website, which is about the markets during the day and about interesting developments in technology and things that I've observed. Again, all my opinion, but it's relevant to what you're doing out there as traders. And of course, anywhere on the internet, you might find also, because I am quite vocal, I think it's important that everybody gets as much information as possible about this constantly evolving and very interesting market. And I'd like to thank you very much, Michael, because the subjects that you're touching on here are very important, and you are going down the route of doing this the right way. And I've seen your approach from the beginning, and you're doing it the right way. I think we have to approach everything in the very modern analytical way these days as a brokerage. So I appreciate the very interesting chat, and look forward to seeing you in London in a couple of weeks' time.
Definitely. Likewise. I'd like to thank everyone for watching today, and we'll be back. I think we're going to be taking a break for the next 2-3 weeks, but we'll be back hopefully before the end of September for another episode. All right. Thank you, everyone. Thank you, Andrew. Thank you.